like to do is about the stock market. When I was in school so many years ago at university, we learned about the efficient market model, which was pure garbage, and apparently whoever wrote this portion of economics didn't have a clue what they were doing in the stock market. The stock market isn't efficient, doesn't balance itself, and no matter what you've heard or how complicated something can be, I'm going to make it extremely simple for you, and I think I can make some sense out of it for you too. The stock market is fear-based. What that means is it's extremely emotional, but that also makes for really good opportunities. COVID, as an example, was wonderful. It dropped the stock market substantially in March. I got to do additional investing. COVID financially for my portfolio, COVID was great. But most things are. Anything that promotes fear will make many investors that are well educated but are still fearful, and it's fear that runs the market. Within the market, you have two types of investing. Speculative investing, the stock market, Las Vegas, your brother-in-law's get rich quick scheme, it really doesn't make any difference. It's speculative investing. There's also value investing. For me, that's very simple. I look at Berkshire Hathaway stock because Warren and his group of investors have the best history for value investing ever. That being the case, why not invest with those guys? Now, within the Berkshire portfolio, what are they most heavily invested in? They're most heavily invested in Apple. So what do? I split my investments between Berkshire Hathaway as a foundation and Apple to maximize my return, which in my case over the years has always exceeded easily over 20%. That's what I look for, a guideline. If I can't do at least 20%, I'm doing something wrong. And it just isn't that hard to do without doing speculative investing and trying to double my money every year and those kind of things. But doing safe, conservative, though, you know, the idea that you can take $6,000 each year, put in a Roth IRA, invest in this manner, and by the time you're 65, have over $52 million, that still sounds like a good return on investment to me. When it comes to investing and the market's going up, I don't just keep investing my money. I put cash to the side and I wait for something fear-based to happen. When something fear-based happens, it's going to lower the price of my Apple, it's going to lower the price of my Berkshire, and I'm going to buy more of it, which is better for my portfolio, because at some point in time, not normally in the too distant future, the fear goes away, the market goes up, and my portfolio is substantially better. You can do the same thing. If you have any questions or comments, just leave them down below. I'm happy to answer whatever questions you might have because, hey, I'm an old guy. It isn't like I've got a lot of free time because I still work for a living, but I like to help people, so that's not an issue. If this video has helped you, please consider subscribing. And I hope you have an enjoyable day and an enjoyable history in the stock market.